Gold is down another 1.35% at the time of recording this video. This follows a period where we've seen gold declining. And how much further is this thing gonna go? Gold has really come off of its all-time highs now. You know, you can see we're looking at a 15-minute chart. If we take a look at the 4-hour chart, I mean, it has really started to potentially trend lower. The question in this video that we'll be talking about is whether or not gold will continue its sell-off, and same thing for stock market indices. Or is the market just going to head lower across the board, or is there a bottom coming soon? Let's talk about it. So yesterday we had the FOMC event where Jerome Powell had a press conference. We saw lots of people ask him questions, and there was a lot of interesting notes that I want to summarize here in this video, and also talk directly about how they impact key markets that I know we all care about, like the gold market, as well as the NASDAQ, the S&P, the Dow, etc. We're going to talk about all of it here. So first of all, what happened to cause gold to spike? Why did this market jump up and then reverse fully? And by the way, it happened on other markets as well. If you take a look at the NASDAQ, I mean, look at these candles. If you're somebody who's watching this and you're long, you're like, yes, I'm long. I saw somebody in our chat who was celebrating this long. I felt bad for them because shortly after, if they had held it, hopefully they took profits, because shortly after, that market completely fell apart. And we're going to talk about why this happened, because again, if you're somebody watching gold or the indices, yesterday's meeting was very volatile and left you with some questions. So here's what happened. The market initially popped because Jerome Powell said that the next move was likely not going to be a hike. So he said rate hikes not likely to be the next move. And the market got really excited because we've seen sticky inflation, strong jobs, and many participants or many, Wall Streeters and people who are, big money managers, they started getting really freaked out thinking Jerome Powell is going to come out and he's going to say a rate hike is possible. And that caused the market to get really scared ahead of the FOMC event. Well, confirmation came out from Jerome Powell that no, rate hikes are not where we think things are going. We still think, cuts will be the next appropriate move. So the market celebrated, and then it fell apart. Why did it fall apart? Well, because still Jerome Powell did sound hawkish yesterday. Even though he didn't have the ultimate hawkishness of saying we're going to rate hike, he did still say things like they wouldn't really budge on cutting rates if there was a little bit of a tick higher in unemployment, and that the sticky inflation and strong economy may need to crack in order for this inflation problem to go away. So the market really freaked out about the idea that there's no real clear guidance as to when those rate cuts are coming. At the beginning of the year, we had the dot plot, which forecasted 3 rate cuts this year from the Fed. We're coming into May now, and people thought there would be cuts by March initially this year. Now we're coming to the summer months, and it doesn't look like we'll see rate cuts anytime soon. In fact, now the expectation is pushed way out. Let me show you. So here is where we're at when it comes to expectations for rate cuts. What we can see here is that the first potential cut is pretty under question whether it is going to be September or November. I mean, now there's a possibility that we don't see a rate cut until December. So what this is saying is this is the current interest rate that we are sitting at, 525 to 550 basis points. So the first rate cut is, of course, what gold and indices alike are looking forward to. They're excited about the prospect of rate cuts because that, again, it gets the money flowing, right? When rate cuts are coming into the market, that's stimulating to the economy, and also the printing of dollars is typically good for gold, right? More dollars means the price of gold relatively goes up. So what we see here is that as of the September meeting, there is a 42.7% chance that we are still holding rates at that current level. And there's a 43.5% chance, basically, there's a slight probability that we do see our first rate cut by September. But before you get too excited about this, we've watched this needle move further and further into the year several times before this. So with the May meeting yesterday, what we saw is again further pushback on when those rate cuts are coming. And that's scaring the market right now. The gold market especially is sensitive to when those rate cuts are happening. The further those get pushed out, the less attractive gold looks. So while a hike may not be the next move, the expectations for rate cuts getting pushed back further and further is not helping the story for gold. I want to take a look at the daily chart with you guys and talk a little bit about what we've got here. We've broken the 2300 level at the time of recording this. The question now will be, if we get a close outside of this level, it very may be the case that we have some short-term bearishness coming for the gold market. And I marked up this support level on the stream today on the daily chart. The next key area of technical support that I see for gold is not until you get down to like 2,200 or 2,175. So that's a little concerning. If you get a break and close underneath this candle today, or this support level today, be very careful if you're looking at gold from a bullish perspective. That being said, it's not all, doom and gloom for gold bulls, I would say, because if you're looking at this, I'll draw up a fresh chart here on the 4-hour chart. If you do start to see buyers come in and support this area, that could be short term. Maybe we're seeing a bounce, and perhaps if we start to see some cooling economic data, maybe you start to see a bottom form for gold. But right now, with rate cuts being pushed back, I just don't see a really short term bullish case for gold. And for me, I'll show you what the Edge Finder has in terms of a scoring. You can see there's no Edge Finder top setups on the very bullish, or bearish readings. If I add in neutral, you can see gold is getting a neutral reading. So if we see more economic data start to cool, if we see yields start to drop, then maybe we get a bullish reading on the Edge Finder for gold. But right now we're getting a neutral read. So I don't have a stake in this game. I'm just sharing what I'm seeing in the markets right now. And as I mentioned, the stock market was all over the place yesterday. Huge jump, huge drop, because again, rate cuts are not certain for when they're coming, but also rate hikes got swiped off the table. So there was a little bit in there for the bulls, but at the same time, again, there's a lot of uncertainty and the market really doesn't like uncertainty, so it sold off. I do have a current position. I'll show you guys. Here is a Russell short. I took a short yesterday during that big spike up on the Russell. The Russell is an area of the market, small cap stocks. When you have the Russell jumping into that short-term news, I actually took that as a opportunity to short again. So I closed out my profitable position yesterday. So we had an entry right around here. The market dropped big. I closed out on this candle. I took profits right around this area. And then the market popped up again further, and I went ahead and actually re-entered my short position. From here, what I'd like to see is the market continue to roll over. If it does not, I have a stop loss above this market structure here. So that's where I'm at with my short position update on the Russell. We'll see how that one wants to play out. And you may be asking, why the Russell specifically? Why not just short the S&P or the NASDAQ? Well, the reason I like the Russell is because of its small cap nature. Smaller companies, mid cap companies, these companies don't have a bajillion dollars of cash sitting around. In fact, they rely heavily on borrowing and a growing economy in order to survive. If we see slowdown in the economy, or borrowing costs go up, which is, again, the 10-year yield going up means borrowing costs are going up. Borrowing costs going up hurt these disproportionately more than the NASDAQ and the S&P. So I think that there is more room to the downside for the Russell than the other ones. That being said, if I'm wrong, I'll stop out on the trade pretty quick. Here's a quick look at some of the current retail positioning that we've got on deck. You can see certain assets that retail is more long on versus more short on. Typically, we take this as a contrarian indicator. So when you have something where retail traders are very long on something, we take that as a bearish signal. And when retail traders are very long on something, we take that as a bearish one. I don't know if I got that right. Basically, we go against the retail trader here. Now, this is not always a holy grail or a simple solution to trading, but understanding where retail traders might be getting caught in a short squeeze or buying a falling knife kind of scenario, we typically keep an eye on that as a possible opportunity. So yeah, something to think about. Here's a look at the put call ratio. This shows the volume of puts relative to calls. You can see that there was a little bit of bearishness that started to come into the market. We've we've now gone back to a little bit more of a normal flat area. And here's the latest round of AAII Investor Sentiment Survey data that shows you what stock market participants are feeling like. You can see there's a slight uptick in bullishness, though this is coming off of a recent low in kind of wavering bullishness. So bearishness started to creep in. I'd say we still have a healthy level of bearishness in the market. So we sometimes take this as a contrarian signal. I mentioned that when you do start to see the survey start to get really bearish, that might be a bullish indicator. And it actually ended up being potentially a short-term bottom, but I still think that there's a little bit of balance here. And I think that with the bulls creeping back in, sellers are still potentially around the corner in the short term for some of the more interest rate sensitive areas of the stock market. And because we just came into the month of May, let's talk a little seasonality month to month. We can see that in the month of May, we do have for gold very slight bullish expectancy in terms of the last 10-year historical average. For the S&P 500, May is actually expected to be positive by 1.27% on a 10-year historical look-back period. You can see we had a big loss in April for the stock market, but perhaps a little bit of a bounce back. We'll just have to see. Again, it's going to be very dependent on what happens with interest rates, but seasonally, this is the stat. Dollar index, a slight positive expectancy for the month of May at 0.26%. And another one that stuck out to me is the NZD USD currency pair, which has some negative expectancy for the month of May. Also, if you'd like to try out this software tool that I'm using, the Edge Finder, we do have a 30-day trial available down below in the description. If you'd like to fill out that application, see if the tool is a right fit for you, you can get up to 30 days access to the tool and try it out for yourself. And here's an updated view of all of my current active trades. I have XLK, which I got assigned. Here's my IWM short, which is just slightly in profit. I also have a semiconductor SMH put that I've sold, which is going okay. With the bounce, it'll look a lot better here today, which is awesome. So we're slightly in profit on that trade. I'll show you SMH, by the way, while we're on the topic. So I sold a put on this when looking at the daily chart. I sold puts as I thought this thing was getting a little overextended, which has turned out to be a nice little profit for me so far. This expires the 24th of May. So as long as we stay above this level by the 24th of May, I'll make a nice profit on this one. And here's my position on VOO. This is the S&P 500 ETF that I use for my options trading. And I sell monthly calls against my position here, or if I'm not in a position, I sell out of the money puts. So I sold out of the money puts and I got assigned on VOO. Now that I have the shares, what I've done is I've turned around and I've sold calls against my position. As you can see here, I sold the 480 call for the 17th of May. This is the 17th of May strike price, 480. So what this is saying is if the market rips between now and that time, I would make money on the shares that I own, obviously, but I also would be required to sell my shares at 480. So at any given point between now and expiration date, I could be required by the person who bought these calls to sell my position to them, which is fine. If they did that right now, that would be, of course, foolish because they would be buying the shares at 480 when they're only trading at 461, 462. So they wouldn't do that now. But if the market ripped, they might choose to buy the shares, and in which case I would need to sell them my shares at 480. That's the way covered calls work. You might say, well, why would you do that, Nick? Because again, you're capping your upside. It's basically like setting a take profit. And why I love options so much is basically this is like setting a take profit and getting paid to put your take profit somewhere. That's the cool thing about the premium, because by selling this covered call against my position, I'm collecting premium. Not a whole lot, but I'm collecting some premium on this position on 4 contracts that I sold against my 400 shares of VOO. So I'm collecting premium. And why did I do this? Well, it's because I think that the market has started to potentially form a bit of a sideways or slightly downward trend. And while that persists, I don't mind capping my upside because I think there's a less likelihood that we do get above 480 by expiration date. So I'm making money on my my calls that I've sold. So I'm collecting premium, collecting profit essentially by creating cash yield off of my position that I have in VOO. This is why I love options. If you'd like to find out more about options, you can search up on YouTube. Or actually, we'll put it up in the top right hand of the screen right now. We'll open up a card to my options trading guide. You can find more information by clicking this link here and check it out. Also, if you would like to trade with the broker that I'm using for my options and everything that I trade pretty much publicly, I use WeBull. If you'd like to get access to WeBull, there will be a link down below in the description for that. It's a wonderful broker, really, really cool stuff. They give you so many analytics, so many cool dashboard features. You could check out all of that by clicking the link to WeBull down below in the description. And if you're looking for other brokerages, check them out down below. There's some really good ones with some great sign-up perks available to my subscribers that I've worked out special deals with my friends at all these brokerages. So these special deals are made available to you because you subscribe and support my channel. Thanks so much for watching. Have a great day. If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel. And we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.